Legal disclaimer. The content presented in this video and the entirety of this series is strictly for educational, informational, and entertainment purposes only. It does not constitute financial, legal, tax, or investment advice. The strategies, case studies, and examples discussed herein are based on historical data and theoretical scenarios which may not apply to your specific financial situation. Financial markets are volatile and past performance is never indicative of future results. The views expressed are those of the creators and do not reflect the official policy or position of any regulatory agency, including the Securities and Exchange Commission or the Financial Industry Regulatory Authority. Before making any decisions regarding your retirement planning, estate planning, or investment portfolio, you are strongly advised to consult with a qualified, licensed financial professional, tax advisor, or attorney who understands your individual objectives and risk tolerance. By continuing to watch, you acknowledge that you assume full responsibility for your own financial choices and agree to conduct your own due diligence. There is a $30 billion industry in the United States that does not want you to watch this video. It is an industry built not on the performance of the S&P 500, nor on the stability of U.S. Treasury bonds, but on a single primal human emotion: the paralyzing fear of running out of money before you die. Every single day, approximately 10,000 Americans turn 65. That is 10,000 new targets entering the crosshairs of a sophisticated, algorithmic marketing machine every 24 hours. If you have checked your 401k balance in the last month, or if you have searched for terms like Social Security optimizers on Google, you are already on a list. You have likely seen the ads. They pop up in your newsfeed, they arrive in your spam folder, and they interrupt your YouTube viewing. They all follow the same script. They promise to reveal a secret IRS loophole, a hidden method to generate tax-free income, or a proprietary strategy to eliminate market risk while capturing market gains. They invite you to a free, exclusive digital event, a webinar. They tell you that seats are limited. They tell you that this information is usually reserved for high-net-worth individuals, but is being released to the public for a limited time. Here is the controversial truth that most financial media outlets are too polite to say out loud. The vast majority of these free retirement planning webinars are not educational masterclasses. They are high-pressure sales funnels disguised as philanthropy. They are sophisticated psychological traps designed to migrate your liquid assets from low-cost, diversified portfolios into high-commission, illiquid insurance products that lock your money away for a decade. We are talking about a structural wealth transfer from the accounts of middle-class retirees into the pockets of unregistered advisors and insurance brokers. However, and this is the critical nuance that keeps this industry alive, not all of them are scams. Some are legitimate. Some truly offer high-value, actionable intelligence that can save you thousands in taxes and help you navigate the labyrinth of Medicare and required minimum distributions. The problem is that to the untrained eye, the shark looks exactly like the pilot fish. They use the same vocabulary. They wear the same suits. They use the same polished slide decks. So, how do you tell the difference before you hand over your email address and your life savings? That is exactly why we are here. Over the course of this 10-part deep dive, we are going to do something that has never been done in this format. We are not just going to review these webinars, we are going to dismantle them. We have signed up for dozens of the most popular retirement seminars targeting U.S. citizens today. We have sat through hundreds of hours of pitches so you do not have to. We have analyzed the fine print that flashes on the screen for 3 seconds. We have cross-referenced their claims with actual tax code and historical market data. We have consulted with fiduciaries and forensic accountants to decode the jargon. This series is the antidote to the anxiety economy. By the time you finish this masterclass, you will possess a specific set of analytical tools. You will be able to look at a landing page and know within 5 seconds if the host is a fiduciary advisor or a salesperson hunting for a commission check. You will understand the mathematical reality behind the guaranteed income claims. You will know exactly what questions to ask to make a presenter stumble. This is about protecting your nest egg. This is about ensuring that the money you worked 40 years to accumulate actually serves you, rather than serving the quarterly revenue targets of a financial marketing organization. To understand the magnitude of this problem, we must first look at the environment that allowed these webinars to flourish. We are currently living through the greatest shift in retirement responsibility in American history. One generation ago, the retirement landscape was dominated by the defined benefit plan, the pension. In that era, your employer bore the investment risk. If the market crashed in 1974, General Motors or IBM had to figure out how to pay your monthly check. You did not need to be an investment expert. You just needed to show up to work. Today, that model is all but extinct for the private sector employee. We have moved to the defined contribution model, the 401k and the IRA. The risk has been transferred entirely from the corporation to you. You are now the chief investment officer of your own future. This shift has created a massive knowledge vacuum. Millions of Americans are approaching their golden years with significant savings, but zero training on how to deaccumulate those assets. Accumulating wealth is relatively simple. Spend less than you earn and invest the difference. Deaccumulating wealth, turning a pile of cash into a reliable paycheck that lasts for 30 years while battling inflation, sequence of returns risk and healthcare costs, is mathematically complex. It is terrifying. And where there is complexity and fear, there is an opening for the guru. The rise of digital communication has supercharged this dynamic. 10 years ago, if a financial salesperson wanted to pitch you a product, they had to rent a conference room at a local Ruth's Chris steakhouse, pay for 50 steak dinners, and physically stand in front of you. It was expensive. It limited their reach to a 20-mile radius. The overhead cost acted as a natural filter. They had to be somewhat successful to afford the bait. Today, the steak dinner has been replaced by the Zoom link. The cost of customer acquisition has plummeted. A salesperson in a basement in Florida can now broadcast a polished, high-production value presentation to 5,000 seniors in Ohio, California, and Texas simultaneously, with almost zero overhead. The barrier to entry has vanished. This democratization of reach means that the volume of noise has exploded. You are being bombarded with conflicting information. One webinar tells you that the stock market is a casino, and you must move everything to gold and silver. The next webinar tells you that gold is a scam and you need to be in high-dividend equities. The third one says taxes will double by 2030, so you must convert everything to a Roth IRA immediately. The fourth one says Roth conversions are a trap. They cannot all be right. In fact, statistically speaking, most of them are presenting half-truths tailored to sell a specific financial vehicle. Throughout this series, we are going to expose the machinery behind the curtain. We will look at the fear funnel, a psychological scripting technique used to agitate your anxiety about a market crash before offering the presenter's product as the only life raft. We will analyze the fake scarcity tactics used to force you into booking an appointment immediately. We will break down the hypothetical illustration, a favorite tool of the industry that shows you charts moving only up and to the right, conveniently omitting the devastating impact of fees and caps on returns. But we will also highlight the green flags. We will show you what a genuine educational webinar looks like. We will showcase the hallmarks of transparency, where an advisor frankly discusses the downsides and liquidity constraints of their strategies. We will teach you how to verify credentials using public government databases like the SEC's Investment Advisor public disclosure website. We are going to empower you to distinguish between a salesperson who sees you as a transaction and a professional who sees you as a client. This is not just about watching videos. This is about your livelihood. The decisions you make in the 5 years before and the 5 years after retirement, the retirement red zone, will determine the quality of your life for decades. One bad decision, one signature on a complex contract you didn't fully understand because a webinar host was charismatic, can cost you hundreds of thousands of dollars in surrender charges and lost opportunity costs. The stakes could not be higher. You might be thinking that you are too smart to fall for a sales pitch. You might think you can spot a scam a mile away, but the data suggests otherwise. These webinars are not designed to trick the unintelligent. They are designed to persuade the prudent. They use real data, real economic trends, and legitimate concerns about the national debt and inflation to build a logical case, before subtly pivoting to a solution that benefits the seller more than the buyer. They exploit your desire to be responsible. They exploit your desire to protect your family. So, if you are currently retired, or if you are planning to retire in the next 10 years, you cannot afford to skip this breakdown. We are going to start at the very beginning of the process, the invitation. In the next part of this series, we will dissect the anatomy of the advertisements that brought you here. We will analyze the specific trigger words used in email subject lines and Facebook captions that bypass your skepticism and compel you to click register. We will uncover the data tracking pixels that follow you across the internet once you engage with these ads, and how the algorithm profiles your net worth before you even enter the virtual room. Prepare yourself. The rabbit hole goes much deeper than you think. Let us pull back the digital curtain on exactly how you ended up on that registration page in the first place. You need to understand that your presence in a retirement webinar is almost never an accident. It is the result of a calculated, high-velocity auction happening in the milliseconds before a web page loads. You are not finding these opportunities are hunting you, and they are using military-grade targeting technology to do it. Imagine for a moment that you are browsing a news site or scrolling through your social media feed. You pause for just 2 seconds on an article headline that reads, Social Security COLA Adjustment for 2025. That 2-second pause is a data point. Yesterday, you might have searched for average retirement savings by age 60, or visited a calculator to estimate your required minimum distributions. Those are data points. The algorithms that power the modern advertising ecosystem, primarily Meta and Google, aggregate these thousands of micro-behaviors to build a high-fidelity avatar of your financial anxiety. They know you are over 55. They know you own your home. They know your estimated net worth is likely between $500,000 and $2 million. You are what the industry calls a qualified lead. Once you are identified as a qualified lead, the bombardment begins. The advertisements you see are not generic billboards. They are precision-guided missiles designed to trigger specific psychological responses. We have analyzed thousands of these ad creatives, and they almost exclusively fall into 2 categories: the fear of loss and the fear of missing out. The fear of loss ads are visceral. They often use stark, high-contrast imagery: a storm cloud over a nest egg, a crumbling stock chart, or a red arrow pointing down. The copy is short and punchy. The 2008 crash destroyed retirement dreams. Is 2025 next? Or warning: the IRS new rule could slice your IRA in half. These ads leverage a concept in behavioral economics known as loss aversion. Studies consistently show that the psychological pain of losing $10,000 is roughly twice as intense as the pleasure of gaining $10,000. The marketers know this. They are not trying to excite you about growth. They are trying to terrify you about contraction. They want you to feel that doing nothing is actually a high-risk decision. On the other side of the spectrum, we have the fear of missing out, or FOMO, ads. These are often framed around secret knowledge or exclusive strategies used by the wealthy. You will see headlines like, How the Ultra-Rich Avoid Taxes on Retirement Income, or The Rich Man's Roth Strategy Explained. These ads appeal to your sense of fairness and curiosity. They imply that there is a 2-tiered system, one for the uninformed masses and one for the insiders, and this webinar is your golden ticket to the inside. They promise to level the playing field, provided you click that sign up button. Let us walk through the user experience of clicking that button step by step so you can see the trap snapping shut. You click the ad. You are immediately redirected to a landing page. This page has one job: conversion. It is stripped of all navigation bars. You cannot click home or about us. Your only options are to close the tab or register. Notice the design elements on this page. At the top, there is almost always a countdown timer ticking down to 0. Webinar starts in 14 minutes and 32 seconds. This creates artificial urgency. It forces your brain to switch from analytical thinking to reactive thinking. You do not want to miss the start, so you rush. Below the timer, you will see a subheadline claiming, Capacity limited to 100 attendees. In the digital world where bandwidth is virtually infinite, a capacity limit is a fabrication. A Zoom webinar can host thousands. A pre-recorded automated webinar can host millions. But by claiming scarcity, they trigger your instinct to hoard resources, in this case a spot in the virtual room. Then comes the form. They ask for your first name, your email, and often your phone number. But lately we are seeing a new trend: the pre-qualification survey. Before you can register, you must answer a few questions. Are you currently retired? Do you have investable assets over $250,000? Do you work with a financial advisor? You might think these questions are there to help the presenter tailor the content to your needs. That is naive. These are exclusionary filters. If you answer that you have less than $50,000 in assets, the automated system might politely tell you that the webinar is full or redirect you to a generic YouTube video. They are filtering out the tire kickers. They are paying $5, $10, sometimes $50 per click to get you to this page. They cannot afford to waste a seat on someone who cannot buy the product they are ultimately selling at the end of the presentation. They are looking for whales, individuals with liquid assets, specifically in the rollover-friendly 401k or IRA bucket. Once you type in your information and hit Secure My Spot, 2 things happen simultaneously. On your screen, you see a confirmation page with a calendar invite. But in the invisible back-end infrastructure, a pixel fires. This piece of code sends a signal back to the advertising platform saying, "This user converted." The algorithm then goes out and finds 10,000 more people who look exactly like you. Same age, same zip code, same browsing history, and serves them the same ad. You have just helped the machine refine its targeting. Simultaneously, your data is often instantly enriched. There are data broker services that can take an email address and a phone number and cross-reference them with property tax records, credit header data, and motor vehicle registrations. Within seconds of you registering, the sales team behind the webinar may know the purchase price of your home, how long you have lived there, and an estimated range of your credit score. You are walking into the room thinking you are anonymous. They are walking into the room holding your dossier. Consider the case of a hypothetical retiree named Robert from Ohio. Robert is 62, recently retired from a manufacturing management role. He is worried about inflation eating into his pension. He sees an ad for a recession-proof retirement masterclass. He registers. He thinks he is simply going to watch a video. He does not realize that by entering his phone number, he has legally opted in to receive SMS marketing and sales calls, bypassing the national do not call registry due to an established business relationship loophole. Before the webinar even begins, Robert receives a text message. "Hi Robert, looking forward to seeing you on the webinar. Have your statements handy so you can follow along." This is a micro-commitment technique. By asking him to bring his statements, they are psychologically preparing him to transact, to move numbers, to take action. The sophistication of the automated webinar cannot be overstated. Many of the sessions you register for are billed as live, but they are pre-recorded simulations. The chat box where you see other attendees typing "Hello from Texas" or "Great point." That is often a programmed script running in sync with the video to create social proof. It makes you feel like you are part of a community of peers who are all agreeing with the presenter. It validates your decision to be there. You are not alone. Hundreds of others are nodding along. If everyone else thinks this is a good idea, surely it must be. This entire ecosystem, the ads, the landing pages, the data enrichment, the fake scarcity, is the pre-frame. Its purpose is to put you in a state of heightened suggestibility. By the time the webinar actually begins, you have already complied with multiple small requests. You clicked. You answered questions. You put it on your calendar. You opened the reminder emails. You are now invested. You have skin in the game. So, you have navigated the minefield of the invitation. You have secured your limited seat. The countdown timer hits 0. The screen fades from black to a professional studio setting, or perhaps a relatable home office with a bookshelf in the background. The host appears. They look trustworthy. They sound knowledgeable. They begin to speak. What happens in the first 10 minutes of that presentation is a masterclass in neurolinguistic programming and authority positioning. They are about to tell you a story. It will sound like history, but it is actually a carefully constructed narrative designed to dismantle your current beliefs about money and replace them with a new reality, one where their product is the only logical solution. But how do they do it without you noticing? How do they take a rational skeptic and turn them into a believer in under 60 minutes? To understand that, we have to dissect the script itself. The webinar begins. The screen typically displays a title slide with bold, sans serif typography, the 2025 Retirement Rescue Plan, or How to Bulletproof Your Income. The host appears, usually sitting in a high-backed leather chair or standing in front of a smartboard. The audio is crisp, the lighting is flattering. For the next 60 minutes, you are the subject of a meticulously choreographed performance. The script they are reading from is not something they scribbled down that morning. It is likely a variation of a proven offer template purchased from a financial marketing agency for thousands of dollars, optimized over hundreds of iterations to maximize viewer retention and emotional buy-in. The first phase of this script is the authority stack. Before they can sell you anything, they must prove they are worth listening to. You will almost invariably see a banner at the bottom of the screen displaying logos of major media networks, as seen on ABC, NBC, CBS, Fox. To the uninitiated, this implies that the host is a recognized expert who has been interviewed on national television news programs. It suggests high-level vetting. Here is the reality behind those logos. In many cases, the host has never appeared on the nightly news. Instead, they have paid a press release distribution service to syndicate a generic article about their firm to the local affiliate websites of these networks. Or they have paid for a sponsored content segment on a local daytime talk show that airs at 11 a.m. on a Tuesday. Technically, they have appeared on the network's platform, But the implication of editorial endorsement is an illusion. It is a borrowed credibility play designed to lower your defenses. If NBC trusts them, you should too, right? Once the logos have flashed, the host pivots to the origin story. This is a critical piece of narrative architecture. They cannot just be a salesperson, they must be a crusader. There are two dominant archetypes here. The first is the Wall Street defector. The host claims they worked for a major brokerage house for 20 years, but left because they were sick of seeing the little guy get ripped off by hidden fees and cookie-cutter advice. They position themselves as the Robin Hood of retirement planning, possessing insider knowledge that they are now benevolent enough to share with you. The second archetype is the personal tragedy. The host shares a somber story about their parents. They recount how their father retired in 2007 with a healthy nest egg, only to see it decimated by the 2008 financial crisis, forcing him to go back to work as a greeter at a retail store. They pause for effect. They look directly into the camera lens. They say, "I made a vow that day that I would never let that happen to another family." This is powerful stuff. It bypasses your logical brain and speaks directly to your empathy and your fear. It frames the transaction not as a business deal, but as a moral imperative. After establishing authority and empathy, the script moves to the housekeeping phase. The host asks you to close your other tabs, put your phone on silent, and grab a pen and paper. "You're going to want to take notes," they say. "We are covering a lot of ground." This commands compliance. It establishes a teacher-student dynamic where they are the professor, and you are the pupil. By physically writing things down, you are reinforcing their points in your own mind. It also serves to isolate you from distractions, keeping you in the echo chamber of the presentation. Now comes the agitation phase. In marketing terms, this is where they twist the knife. They have to dismantle your confidence in the traditional retirement strategies you have used for the last 30 years. They need to convince you that the old rules, buy and hold, diversify stock and bond splits, are broken. They often start by attacking the 60-40 portfolio. They will pull up a chart showing interest rates over the last 40 years. They will explain that for decades, bonds were the safety net of a portfolio, providing steady interest and price stability. Then, they will pivot to the current economic environment. They will discuss the inverse relationship between interest rates and bond prices. They will show a worst-case scenario simulation where rising rates crush bond values at the same time that a recession hits the stock market. They call this the perfect storm. They will say things like, "The safe portion of your portfolio isn't safe anymore. Where will you hide when both stocks and bonds go down together?" This is a legitimate economic concern, but in the context of the webinar, it is being amplified to induce a specific state of anxiety. They are systematically removing the pillars of safety you thought you had. Next, they introduce the concept of sequence of returns risk. This is the technical term for retiring into a bear market. They will show you two hypothetical retirees, Mr. Green and Mr. Red. Mr. Green retires in a bull market. Mr. Red retires in a bear market. They both have the same average return over 20 years, and they both withdraw the same amount of money. But because Mr. Red lost money in the first 3 years, he runs out of money at age 80, while Mr. Green dies with millions. The slide showing Mr. Red's account hitting zero is arguably the most terrifying graphic in the entire presentation. It strikes at the heart of the longevity risk, the fear of outliving your money. The host will linger on this slide. They will ask, "Can you afford to gamble on which market cycle you retire into? Do you want your dignity to depend on the roll of the dice?" Then they introduce the tax train. They will display a graphic of the U.S. national debt, a number climbing into the tens of trillions. They will quote experts or politicians suggesting that tax rates are at historic lows and must inevitably rise to pay for this debt. They will describe your 401k and IRA not as assets, but as a joint account with Uncle Sam, where the government gets to decide the withdrawal rate whenever they want. "You think you have $1 million, they will say, but if taxes go to 50%, you only have $500,000. The government is the majority shareholder in your retirement." At this point, about 20 minutes into the webinar, you are likely feeling a sense of unease. The old way of investing feels dangerous. The stock market is a casino. The bond market is a bubble. The government is coming for your money. This is the gap. They have created a massive gap between where you are, danger, and where you want to be, safety. This is the psychological pivot point. If they ended the webinar here, you would be hopeless. But they don't. This is exactly where they hint that there is a third option, a strategy that the mainstream media ignores. a vehicle that banks use for their own money but don't sell to you. They start to use phrases like participation without risk, locked-in gains, and contractual guarantees. They might show a chart that looks like a staircase. It goes up when the market is up but goes flat when the market crashes. It never goes down. It looks like magic. It looks like the solution to every problem they just spent 20 minutes terrifying you with. But here is the catch. They rarely name the product immediately. They call it a strategy or a proprietary indexing method. They keep it mysterious to build curiosity. They want you to beg for the solution. What they are describing, almost without exception, is a fixed index annuity or an indexed universal life insurance policy. These are complex insurance products, not simple investment accounts. But in the narrative of the webinar, they are presented as the Holy Grail. As they transition into revealing this solution, the math gets fuzzy. The clear, terrifying charts about the national debt are replaced by hypothetical illustrations of this mystery vehicle performing perfectly over a selected time frame. They will show you how, if you had used this strategy during the 2008 crash or the 2020 pandemic drop, you would have lost nothing. But what they are leaving out of these perfect charts is just as important as what they are putting in. They are omitting the caps on your upside. They are omitting the surrender periods that lock up your cash for 10 or 15 years. They are omitting the internal fees that can drag on performance. You are now halfway through the masterclass. The trap has been set. The fear has been installed, and the miracle cure has been teased. But simply showing you the product isn't enough to get you to sign the contract. They need to overcome your skepticism. They need to prove that this too good to be true solution is actually real. To do that, they are about to deploy the most deceptive weapon in their arsenal, the case study that isn't quite what it seems. In the next part of this series, we are going to dissect the hypothetical illustration. We will take the exact charts used in these webinars and run them through independent analysis software. We will show you how shifting a start date by just 2 years can turn a losing strategy into a winning one on paper. We will expose the cap and participation rate game that caps your gains while inflation eats your principal. The numbers lie, and we are going to show you exactly how they cook the books. Now we are going to perform a forensic audit on the single most persuasive slide in the entire webinar deck. Industry insiders often call it the staircase to heaven. On the screen you see 2 lines. The first line is jagged, volatile, and stressful. It represents the S&P 500. It climbs, it crashes, it claws its way back, then it dips again. It represents chaos. The second line is smooth, steady, and ascends in a perfect ratchet-like motion. It goes up when the market goes up, but when the market crashes, the line simply goes flat. It never dips. It locks in every gain like a mountaineer securing a safety rope. The presenter points to this chart and delivers the line that seals the deal for millions of retirees. Zero is your hero. They explain that because you never take a loss, the mathematics of compounding interest work in your favor so powerfully that you can actually outperform the stock market over time with zero risk. It sounds intuitive, feels safe. It looks like the financial equivalent of having your cake and eating it too. But here is the data they are scrubbing from that chart. That smooth, beautiful line is almost always modeling a fixed index annuity or an indexed universal life insurance policy. To make that line look competitive with the stock market, the illustration relies on 3 specific suppressions of truth: the dividend exclusion, the cap reality, and the volatility trap. Let's start with the dividend exclusion. This is the silent killer of returns. When the presenter says, you earn interest based on the performance of the S&P 500, they are using a very specific legal definition. They are tracking the S&P 500 price index, not the S&P 500 total return index. The difference is dividends. Historically, dividends have accounted for approximately 40% of the total return of the stock market. When you own an index fund or an ETF, you get the growth of the stock prices plus the quarterly dividend payments. In these insurance products, the insurance company keeps the dividends. You never see them. So let's run the numbers. Imagine the S&P 500 goes up 10% in price this year and pays a 2% dividend. A direct investor earns 12%. The webinar product tracks only the price, so it sees a 10% gain. You are already starting with a 20% handicap before fees or caps are even applied. Over a 20-year retirement, losing those dividends is the mathematical equivalent of drilling a hole in the bottom of your boat. Next, we have to talk about the cap. The webinar host will breezily mention that in exchange for downside protection, you accept a limit on the upside. They might say, if the market does 20%, you might only get 10%. But isn't that a fair trade for never losing money? The problem is that the caps in the real world are rarely that generous, especially in low interest rate environments. Currently, many of these products have caps hovering between 4% and 7%. Let's simulate this with an imagine-if scenario. Imagine it is the year following a recession. The market often snaps back violently. This is called a recovery rally. Let's say the S&P 500 rebounds by 25%. If you are in a traditional portfolio, you capture that full 25% plus dividends, which helps repair the damage from the previous year. But if you are in the webinar product with a 5% cap, you get exactly 5%. The market just sprinted a marathon and you were forced to walk. This creates a phenomenon known as recovery lag. While the staircase chart shows you not losing money during the crash, it fails to visualize the opportunity cost of missing the recovery. If the market drops 20%, you stay flat. Great. But if the market then gains 20% the next 3 years in a row to recover, the market investor is back to new highs. Meanwhile, capped at 5%, you are mathematically left in the dust. You didn't lose principal, but you lost purchasing power. This brings us to the third and most sophisticated manipulation, the proprietary volatility control index. In recent years, regulators have cracked down on how optimistic these illustrations can be using standard indices like the S&P 500. So the industry pivoted. Now many webinars pitch indices you have never heard of. They sound impressive with names like the JP Morgan Mosaic 2 or the Barclays Trailblazer. These are custom-engineered indices created by investment banks specifically for insurance companies to sell to you. These indices use a mechanism called volatility control. Put simply, if the stock market gets choppy, the index automatically sells stocks and buys cash or bonds to stabilize the price. The sales pitch is that this creates smooth, steady growth. The reality is that it systematically neuters your returns. By design, these indices are often engineered to return roughly 4 to 5% before fees. Now look closely at the fine print on the bottom of the webinar slide. You will often see a disclaimer that says back-tested data. This means the index didn't actually exist for the 20 years shown on the chart. It was created last year. The bank used a computer to look at historical data and asked, what combination of assets would have performed perfectly over the last decade? They then built the index to match that perfect past. It is like betting on a horse race after you already know who won. They present this back-tested perfection as a potential outcome. But in the real world, once the index goes live, it rarely repeats that performance. We have seen proprietary indices that showed stunning back-tested returns of 8% suddenly flatline to 0 or 1% the moment they were sold to the public. Why? Because the specific market conditions that the computer model exploited no longer existed. You are buying a strategy that is perfectly optimized for yesterday's weather. And we haven't even touched on the participation rate trick yet. Sometimes, instead of a hard cap, they offer uncapped growth but with the participation rate. They say, you get 50% of whatever the market does with no limit. It sounds fantastic. If the market does 30%, you get 15%. That beats a 5% cap, right? Here is the trapdoor. The insurance company reserves the right to change that participation rate annually. You might sign the contract with a 50% participation rate. 3 years later, once you are locked in and the surrender charges are high, they can legally drop that rate to 30% or 20% depending on the contract terms. You are not buying a static product. You are entering a dynamic contract where the other party holds the eraser. So let's re-examine that staircase to heaven. When you strip away the dividends, apply the rigid caps, factor in the fees, which can range from 1 to 3% explicitly or implicitly, and account for the inflation that eats away at your safe 4% return. The staircase doesn't look like a path to wealth. It looks like a path to a slow, guaranteed erosion of your lifestyle. You aren't running out of money. You are running out of buying power. The webinar host knows this. They know that if they explain the mechanics of dividends, caps, and participation renewal rates in plain English, the room would empty out. So they don't. They focus on the emotional win, safety. Sleep well at night, they repeat. Protect your legacy. They are selling you an expensive insurance policy, wrapped in the camouflage of an investment vehicle. But let's assume you are still intrigued. You are risk-averse. You are okay with lower returns if it means zero loss. You decide to stay until the end of the webinar. The presentation is wrapping up. The host stops sharing the slides. They lean in. The tone shifts from educational to urgent. They have one final hurdle to clear. They need to get you off the computer and on the phone. They can't just ask for an appointment. That feels like a sales call. They need to package the next step as a prize, a reward for the action takers. They are about to deploy the consultation rebrand. They will tell you that their time is normally billed at $500 an hour, but for the people in this room, they are going to do something crazy. This is where the psychological funnel moves from mass indoctrination to one-on-one extraction. You are about to be offered a customized retirement roadmap, a tax-free analysis, or a social security maximization report. It sounds like a deliverable product. It sounds like they are going to do days of work for you for free. In the next part of our deep dive, we are going to take you inside that private strategy session. We actually booked these calls. We recorded what happened. We will show you the script they use when the camera is off and the sales pressure is turned on. We will reveal the fact finder document they ask you to fill out, a document that serves less as a planning tool and more as a map to your liquidity. You think you are getting a financial plan. You are actually handing over the blueprints to your vault. You are now sitting at your kitchen table. It is 2 p.m. on a Tuesday. The laptop is open, and you are 5 minutes into the exclusive strategy session you booked at the end of the webinar. The host, or more likely a senior vice president from their firm, is on the screen. They are warm, disarming, and professionally dressed. They start by setting the ground rules. We are not here to sell you anything today. We are just here to see if we are a good fit. This is the takeaway close before the meeting even starts. By suggesting they might not accept you as a client, they subtly shift the power dynamic. You are no longer evaluating them, they are evaluating you. They ask you to upload your financial statements to a secure portal prior to the call. If you did this, you have just handed them the ammunition they need to dismantle your current financial life. They pull up your Vanguard or Fidelity statement on the shared screen. They don't look at the growth over the last 10 years. They don't look at the low expense ratios. They zoom in on one thing: risk. This is where the stress test software comes into play. They run your portfolio through a proprietary analysis tool. The screen turns red. "Oh," they say with a tone of concerned surprise. "I see you are currently holding a target date 2030 fund. Did you know that in 2008, funds with this similar composition lost 35%? They are cherry-picking a worst-case historical event to invalidate a diversified strategy." They might say, "You are 62 years old. You don't have the time to recover from another 2008. You are driving a race car on an icy road." Then they pivot to the fee analysis. This is one of the most ironic parts of the entire sales process. They will tear apart your mutual funds for having an expense ratio of 0.7% or 1%. They will calculate exactly how much that costs you over 20 years. "That is $100,000 coming out of your pocket," they exclaim. They position themselves as the cost cutters. What they do not mention is that the product they are about to pitch you, the equity indexed annuity or IUL, often carries internal mortality and expense charges, rider fees, and surrender penalties that can effectively exceed 2 to 3% annually. But because those costs are netted out of the returns rather than billed directly, they can legally claim you pay zero out-of-pocket fees. It is a sleight of hand. They are replacing a visible low fee with an invisible high cost. Let's look at a specific case study to illustrate how this conversation typically goes. We will call our subjects James and Sarah. They have saved $1.2 million in a mix of 401ks and IRAs. They are proud of this. They followed the rules. The webinar sales agent looks at their portfolio and introduces the concept of the tax torpedo. "James, Sarah," the agent says, leaning in, "you have done a great job saving. But you haven't saved any money. You have saved a tax liability. Every dollar in this account is owned by the IRS. When you turn 73, the government is going to force you to withdraw this money whether you need it or not. That could push your tax bracket up, double your Medicare premiums, and cause your Social Security to be taxed at 85%. This is the problem agitation phase. They are technically correct. Required minimum distributions, RMDs, are a real tax issue. But their solution is rarely a measured plan of gradual Roth conversions or tax bracket management. Their solution is a blunt force transfer. They will propose moving a massive chunk of that 401k, often nearly all of it, into their proprietary insurance product. They frame this as moving money from the risk bucket to the safety bucket. They might use color coding: red money, stocks, versus green money, annuities. "How much of your hard-earned money are you willing to lose?" they ask. "If the market drops tomorrow, do you want to be red or green?" It is a binary choice designed to bypass critical thinking. Nuance is the enemy of the sale. At this stage, you might ask a very reasonable question. If this is so good, why hasn't my current financial advisor told me about it? They have a scripted answer for this too. They will tell you that your current advisor is captive. They will say, Wall Street brokers are only allowed to sell you products that have risk because that is how they get paid ongoing management fees. If you are safe, they don't make money. This paints the webinar host as the independent hero fighting the corrupt system. However, there is a critical distinction you must understand here, one that is almost never disclosed on the Zoom call. In the United States, there is a legal difference between a fiduciary and a suitability standard. A registered investment advisor, RIA, is a fiduciary. They are legally required to act in your best interest, even if it means they make less money. Many webinar hosts, however, are operating under a simplistic insurance license. They are held to the suitability standard. This means the product they sell you just has to be suitable for your age and net worth. It does not have to be the best option for you. It can be a mediocre product that pays them a massive commission, as long as it isn't blatantly illegal. This commission is the elephant in the room. If James and Sarah moved that $1.2 million into the recommended annuity, the agent on the other end of that Zoom call could instantly generate a commission of anywhere from 5 to 9%. That is a payday of $60,000 to $108,000 for a single signature. That commission is paid upfront by the insurance company. That is why the webinar was free. That is why the strategy session was free. That is why the steak dinner was free. You are not the client. You are the inventory. But the agent won't ask you to sign on the first call. That looks desperate. Instead, they end the meeting with the custom build. They say, James, Sarah, I think we can really help you fix this tax bomb and lock in your retirement. But I need to run some numbers with my actuarial team. I want to build a custom plan just for you. Let's meet again on Thursday to review the solution. They are buying time to generate the illustration. A 30-page document filled with legal disclaimers and charts that go up and to the right. When you come back for that second meeting, the psychology shifts from evaluation to salvation. They are going to present the solution as the only logical path to safety. Before we move to that second meeting, we need to address the bonus they are likely to dangle in front of you. This is the final hook. To incentivize you to move your money now, they will often mention a premium bonus. They will say, if we get this application in by the end of the month, the carrier will add a 10% bonus to your account day one. You transfer $1 million and you start with $1.1 million instantly. You just made $100,000 just by signing your name. Sounds like free money. It triggers a dopamine rush. But in the financial world, there is no such thing as a free lunch. That bonus is not a gift. It is a loan you pay back through lower returns and higher surrender charges over the next 10 years. It is the handcuffs that keep you locked in the product. So you hang up the Zoom call. You feel a mix of fear about your current portfolio and relief that there is a solution. You and your spouse discuss it. He seemed really nice, you say. He knew so much about taxes. You are halfway down the funnel. But what exactly is inside that 30-page document they are preparing for you? What are the gotchas buried in the definitions on page 24? And most importantly, once you sign that contract, is your money actually accessible? Or have you just locked it away in a vault that you don't have the key to? In the next part of this deep dive, we are going to analyze the contract. We have obtained actual policy documents from the biggest providers sold in these webinars. We are going to highlight the surrender charge schedule, the trap that dictates you can't touch your own money for up to 15 years without a massive penalty. We will look at the market value adjustment clause that can drain your account, even if the market is up. You are about to see the fine print that the PowerPoint slides conveniently forgot to mention. The document usually arrives via FedEx or priority mail about 2 weeks after you sign the initial application. It is not a glossy brochure. It is a thick, dense, perfect bound booklet, often running 40 to 60 pages in length. This is the policy. This is the legal reality of the transaction you have just entered into. And here is the uncomfortable truth. 90% of the people who buy these products based on a webinar pitch never read past the first 3 pages. They look at the summary sheet, check that their name is spelled correctly, verify the deposit amount, and file it away in a drawer, believing their retirement is now safe. If you were to actually open that booklet to the section titled Surrender Charges and Withdrawals, you would find a table that fundamentally contradicts the message of financial freedom you heard on the webinar. This table is the handcuffs. In the industry, this is known as the surrender charge schedule, and it is the mechanism that transforms your liquid cash into an illiquid contract. Let's examine a standard 10-year surrender schedule, which is common for the types of fixed index annuities sold in these high-pressure funnels. The schedule might look like this: year 1, 10%, year 2, 9%, year 3, 8%, and so on, declining by 1% a year until it reaches 0 in year 11. This means that if you deposit $500,000 and 2 years later life happens, perhaps you need to pay for an unexpected surgery, help a child with a down payment, or simply decide you don't like the low returns you are getting, you cannot just take your money back. If you withdraw your full account balance in year 2, the insurance company will keep 9% of your money. That is a $45,000 penalty. But it gets worse. Remember that premium bonus they gave you? That free 10% they added to your account on day 1? That is almost always subject to a vesting schedule. If you leave early, they claw that bonus back in its entirety. So, you lose the $45,000 in penalties, plus the $50,000 bonus you thought was yours. You are walking away with significantly less than you put in, despite the 0 is your hero promise. The webinar host likely glossed over this by saying, "You can withdraw 10% a year penalty-free." And that is usually true. But ask yourself, is access to only 10% of your life savings enough liquidity for a 20-year retirement? If you need 20% for an emergency, you are penalized on the excess. You have effectively locked your nest egg in a vault where the insurance company holds the combination, and they only slide a few bills under the door once a year. Now let's look at the market value adjustment, or MVA. This is a clause buried deep in the definitions section that can devastate your exit plan, yet it is almost never mentioned in the sales presentation. The MVA is a risk-sharing mechanism designed to protect the insurance company, not you. It functions similarly to a bond. If interest rates rise after you buy your policy, the assets the insurance company bought with your money lose value. If you try to cash out early during a period of rising rates like the environment we have seen recently, the MVA kicks in. Here is the scenario. You want to surrender the policy in year 5. You are willing to pay the surrender charge. But because interest rates are 2% higher now than when you bought the policy, the MVA applies a further reduction to your cash value to compensate the insurer for their loss. We have analyzed contracts where the MVA combined with the surrender charge wiped out over 15% of a client's principal. They entered the contract to avoid market loss, only to suffer a massive contractual loss because they needed their own money back. But perhaps the most misunderstood aspect of these contracts is the income rider. This is the feature that generates the guaranteed lifetime income discussed in the webinar. The agent probably showed you a hypothetical illustration where your account grows at a guaranteed roll-up rate of 7 or 8%. They point to a column called the income base, or benefit base, growing exponentially. You see your $500,000 turning into $1 million in just a few years. You need to understand the difference between real money and monopoly money. In these contracts, you have two values. One is the accumulation value. This is your real cash, susceptible to caps, fees, and 0% growth years. The other is the income base. The income base is a fictitious number. It is a ledger entry used solely to calculate how much your monthly check will be if, and only if, you turn on the lifetime income stream. You cannot cash out the income base. You cannot walk away with it. You cannot leave it as a lump sum to your heirs. Let's say your income base grows to $1 million thanks to that guaranteed 8% roll-up. But your real cash value is only $600,000 because the market has been flat. If you die, your beneficiaries get the $600,000, not the million. If you cash out, you get the $600,000 minus penalties. That $1 million figure is a mirage designed to make the fee worth it. And speaking of fees, that income rider is not free. It typically costs around 1% of the income base annually. Note the distinction. It is charged on the higher fictitious number, but it is deducted from your real cash accumulation value. Imagine this scenario. You have a year where the stock market is flat. Your index return is 0, but you have a rider fee of 1%. That fee is deducted from your principal. So, in a year where the webinar promised you never lose money, you actually lost 1% due to fees. If this happens 3 years in a row, your real account value is draining away, dragging down the compound growth potential when the market finally does recover. You are running on a treadmill where the fees are constantly increasing the incline. Case studies suggest that for many retirees, the cost of the rider drags the net performance of the policy down to the level of a bond portfolio or a high-yield savings account, but with none of the liquidity. You are paying luxury car prices for public transportation performance. Furthermore, we must address the term annuitization. This is a word that scares the industry because it implies a loss of control. When you finally decide to turn that income base into a paycheck, you are often entering a new phase of the contract. In many traditional structures, to get the highest payout, you effectively hand over your lump sum to the insurance company in exchange for the monthly check. If you die 2 years later, the payments stop, and the company keeps the remainder of the lump sum. Now, to be fair, many modern income riders are designed to avoid full annuitization, allowing you to maintain control of the remaining cash value. However, the withdrawal rate is mathematically calculated to ensure you are mostly just withdrawing your own principal for the first 15 years. If you start taking income at age 65, the insurance company is giving you your own money back until you are roughly 82. Only if you live past 82 do you dip into the insurance company's pockets. You have effectively given them an interest-free loan of your life savings for 20 years, and they are paying you back with your own money while keeping the investment returns for themselves. It is crucial to note that there is a free look period. In most states, you have 10 to 30 days after receiving the physical policy to return it for a full refund. No questions asked. This is your last line of defense. However, aggressive agents know this. They will often hand-deliver the policy or schedule a delivery review, meeting to reassure you, answer questions, and frankly, to stall until the clock runs out on the free look period. They might say, "Don't worry about all that legal jargon, it's just standard boilerplate." The illustration showed you the real plan. Do not rely on the verbal reassurance of a salesperson over the written text of a legal contract. The contract always wins in court. So, why do they push these specific products with such intensity? Why does the webinar funnel almost always lead to an equity index annuity or IUL, rather than a diversified portfolio of low-cost ETFs or a simple treasury ladder? The answer lies in a document you will never see. A document that circulates only within the sales offices of financial marketing organizations. It is called the commission grid. In the next part of this masterclass, we are going to follow the money. We are going to reveal exactly how much the host of that webinar was paid for your signature. We will compare the compensation of a fiduciary advisor, who charges a transparent fee, versus the compensation of a transactional salesperson. We will explain the concept of trail commissions and exotic trips to Cabo San Lucas awarded for hitting sales quotas. You need to know if the advice you are receiving is based on your retirement needs or their revenue targets. We are about to expose the economy of influence. To understand why you are being pitched a complex insurance contract instead of a simple low-cost investment portfolio, you do not need a degree in finance. You need to understand the architecture of the commission grid. This is the unseen ledger that dictates the behavior of the vast majority of webinar hosts. While you are looking at charts of historical returns, the presenter is looking at a chart of payout percentages. The misalignment between your financial health and their financial reward is not just a crack in the system. It is the foundation upon which this entire industry is built. Let us walk through a concrete scenario to make this tangible. Imagine you have saved $500,000 in your 401k. You attend a webinar, book a consultation, and are presented with two potential paths. Path A is a diversified portfolio of low-cost index funds, perhaps a mix of total stock market and total bond market ETFs. This portfolio is liquid, transparent, and historically has provided strong returns. If the advisor were to recommend this, and they were a pure commission-based broker, they might earn a negligible amount, perhaps a few $100s in trading fees, or zero if they use modern zero-commission platforms. If they were a fee-only fiduciary, they might charge you a flat project fee of $2,000 to set it up, or a 1% annual fee to manage it. In the fee-only model, to make $35,000 from you, they would have to serve you diligently for 7 years. They have to earn your trust every single day to keep the relationship. Path B is the fixed index annuity or indexed universal life policy. This is the product they are pushing. The moment you sign the paper to transfer that $500,000, a heaped commission is triggered. Heaped is the industry term for getting paid all at once up front. For a standard 10-year surrender annuity, the commission rate typically hovers between 6 and 8%. Let's use a conservative 6%. That is a $30,000 check deposited into the agent's account within days of the fund's clearing. $30,000 for 3 hours of work, 1 hour for the webinar, 1 hour for the strategy session, and 1 hour for the paperwork. Now ask yourself, is it humanly possible for a salesperson to be truly objective when one option pays them zero, or requires 7 years of work to earn the same amount? and the other option pays them $30,000 instantly. This is not to say that every agent is malicious. Many truly believe in their products. But Upton Sinclair famously said, "It is difficult to get a man to understand something when his salary depends upon his not understanding it." The commission creates a blinding bias. It turns the advisor into a hammer, and your retirement savings into a nail. Every problem looks like it can be solved with an annuity because that is the only tool that pays the bills. But the money trail does not stop at the agent. We have to look higher up the food chain to the FMO, the Field Marketing Organization. Most of these independent webinar hosts are not truly independent. They are affiliated with a massive aggregation firm that sits between them and the insurance carriers. These FMOs are the ones providing the webinar scripts, the slide decks, and often the funding for the Facebook ads that caught your attention. Why would an FMO pay thousands of dollars for an agent's marketing? Because of the override. When that agent sells you the $500,000 policy, they get their 6%. The FMO gets an additional override commission from the insurance carrier, often another 1 to 2%. They have a vested interest in churning out as much volume as possible. This industrializes the sales process. The webinar is not an educational event. It is a manufacturing line for commissions. Then come the incentives. If you look closely at the office walls of some of these high-volume agents, you won't just see diplomas. You will see plaques for President's Club or $1 Million Roundtable. These awards are not given for client satisfaction. They are not given for portfolio performance. They are given strictly for premium written, the total amount of client dollars captured. The insurance carriers know exactly how to motivate their sales force. They run contest periods, often towards the end of the calendar year. You might see a contest flyer that reads, "Sell $3 million in annuity premium by December 31st and qualify for the Elite Producer Retreat in Bora Bora. Expenses paid. 5-star luxury. Spouses included." Consider the implications of this. If you are sitting in a strategy session in November, and the agent is $50,000 short of qualifying for a $20,000 vacation, how aggressively do you think they are going to push that contract? Are they thinking about your liquidity needs in 2032? Or are they thinking about the overwater bungalow in 2026? The conflict of interest is palpable. The educational advice is being warped by the promise of a tan. And remember, this money, the $30,000 commission, the override, the cost of the trip, is not coming out of thin air. It is coming from the profitability of the product you bought. The insurance company prices the product to account for these massive acquisition costs. This is why the caps and participation rates we discussed earlier are so low. They have to be. The carrier has to recoup the 8 to 10% they just paid out in distribution costs before they can start making a profit for themselves. You are effectively paying for your own salesman's commission through years of subpar returns. The industry defends this model by saying, the client pays zero fees. As we discussed, this is technically true in terms of line item deductions on a statement, but it is functionally false. You pay an opportunity cost. If a standard investment portfolio returns 8% and your annuity returns 4% because the insurance company took the other 4% to pay commissions and hedge costs, you have paid a 4% fee. That is 4 times higher than the typical 1% fee of a fiduciary advisor, and 40 times higher than the 0.1% fee of a DIY index fund strategy. This brings us to the concept of suitability versus fiduciary again. It is perfectly legal for a non-fiduciary agent to sell you a product that pays them the highest commission, as long as it is roughly suitable for your situation. They do not have to disclose that there was a better, cheaper product available that paid them less. They are not required to show you the commission grid. In fact, if you ask them, "How much are you making on this?" they are trained to deflect. They might say, "I am paid directly by the insurance company, so it doesn't come out of your account." This is a half-truth designed to shut down inquiry. Compare this to the fiduciary standard. A registered investment advisor, RIA, must legally sign a document stating they will act in your best interest. They must disclose conflicts of interest. Most importantly, many operate on a fee-only basis. This means they do not accept commissions from anyone. If they recommend an insurance product, they are recommending it because it fits your plan, not because it funds their payroll. The difference in the quality of advice you receive when the compensation model is aligned with your success rather than your transaction volume is night and day. Furthermore, there is the issue of churning or twisting. The surrender charge schedule on an annuity usually lasts 10 years. Coincidentally, that is exactly when the agent calls you back. Great news, they will say. Your surrender period is over. You are free. But instead of suggesting you take your money and enjoy the liquidity, they will often pitch a 1035 exchange. This is a tax-free transfer to a new annuity. Why? Because the new annuity starts a new commission cycle. They get paid another 6%. You get locked up for another 10 years. The cycle repeats until you die or the money runs out. You are a renewable resource for their revenue stream. So when you are watching that webinar and the host seems so generous with their time, so eager to help you solve your retirement puzzle, remember the invisible machinery humming in the background. The free information is the bait, the strategy session is the net, and the product is the cage. But let's assume you avoid the trap. Let's assume you see through the commission incentives and decide to stick with a traditional investment portfolio. The webinar host has one final argument to throw at you, and it is a heavy one. They will pivot away from safety and returns and focus entirely on the one thing you cannot control, the government. They are going to try to convince you that your 401k is a ticking time bomb, not because of the market but because of taxes. They will use the phrase, the tsunami of taxation. They will claim that tax rates are destined to double, wiping out your wealth if you don't move your money into their tax-free vehicle immediately. In the next part of this deep dive, we are going to dismantle the tax scare. We will look at the actual historical data on tax rates, which were once over 90%, and analyze the probability of them doubling in your lifetime. We will expose the mathematical fallacy of the tax-free sales pitch, where they convince you to pay taxes now to avoid taxes later, often at a cost that far exceeds the benefit. You are about to learn why avoiding taxes at all costs might be the most expensive decision you ever make. The segment begins with a graphic you have likely seen in every single financial presentation you have attended: the national debt clock. The numbers are spinning wildly: 34 trillion, 35 trillion. A blur of red digits that seem to scream imminent collapse. The webinar host pauses for a dramatic effect. They drop their voice to a conspiratorial whisper. The government is broke, they say. They have made promises they cannot keep. Social Security, Medicare, the interest on the debt. There is only one way they can pay for this. They have to raise your taxes. And they won't just raise them a little. They will double them. This is the tax apocalypse narrative. It is the most potent fear-mongering tool in the modern sales arsenal because it relies on a kernel of truth. The US debt is indeed historically high. To justify a massive, expensive financial decision, they will tell you that we are currently in the lowest tax environment of your lifetime, and that leaving your money in a 401k or IRA is like leaving your house unlocked in a high-crime neighborhood. But before you panic and liquidate your tax-deferred accounts, we need to look at the historical data they are conveniently omitting. They often cite the 1950s, noting that the top marginal tax rate was over 90%. See, they say, it has happened before, it will happen again. What they do not tell you is that almost nobody actually paid that 90% rate. The tax code in the 1950s was Swiss cheese, filled with massive loopholes and deductions that no longer exist. The effective tax rate, the percentage of income the wealthy actually paid, was not drastically different from what it is today. Furthermore, the taxes must double argument assumes that raising income tax is the only lever the government has. It ignores the political suicide of doubling taxes on the middle class. It ignores the possibility of consumption taxes, value-added taxes, or simply printing money and accepting inflation as the hidden tax. By predicting a specific catastrophic outcome, 50% tax rates for middle-class retirees, they are fabricating a certainty out of a complex economic variable. Now let's dismantle their favorite analogy: the seed versus the harvest. You will hear this in almost every webinar. The host asks, if you were a farmer, would you rather pay tax on the seed, the small bag of grain you buy in the spring, or the harvest, the massive crop you sell in the fall? The audience nods. Seems like common sense. Why would I want to pay tax on the big number, the harvest/your retirement balance, when I can pay tax on the small number, the seed/your current contribution? They use this logic to push you toward Roth conversions or, more lucratively for them, life insurance retirement plans, LIRPs. But this is a mathematical lie. It relies on your brain's inability to process the commutative property of multiplication. Let's run the math. Imagine you have $10,000. The tax rate is 25%. You can double your money over 10 years. Scenario A: tax the seed, you pay the 25% tax now. You are left with $7,500. You invest it. It doubles. You end up with $15,000. Scenario B: Tax the harvest, you invest the full $10,000. Tax deferred. It doubles to $20,000. Now you pay the 25% tax. That is $5,000. You are left with $15,000. The result is identical. $15,000 versus $15,000. The seed versus harvest analogy is a semantic trick designed to make you feel like paying taxes later is a mathematical error. It isn't. The only variable that matters is whether your tax rate will be higher or lower in retirement than it is today. And this brings us to the progressive tax illusion. The webinar host wants you to believe that in retirement, you will be in a higher tax bracket because you lose your mortgage deduction and your kids are grown. They scream, "You'll be taxed on every dollar." In reality, the U.S. tax system is progressive. The first tranche of your income, the standard deduction, is taxed at 0%. For a married couple over 65 in 2025, that is nearly $30,000 of income completely tax-free, without doing anything special. The next chunk is taxed at 10%. The next at 12%. You can have over $100,000 of taxable income and still have an effective tax rate of under 12%. The webinar host compares your marginal rate today with a hypothetical marginal rate in the future. But your withdrawals fill up those lower buckets first. For many retirees, their effective tax rate actually drops in retirement, even if statutory rates rise slightly. By convincing you to pay taxes now at your current high earning rate, to avoid taxes later when you might have little other income, they might actually be increasing your lifetime tax bill. But why are they pushing this so hard? Because the solution to the tax problem is often the rich man's Roth, otherwise known as Indexed Universal Life, IUL insurance. They pitch this as the ultimate vehicle. Tax-free growth, tax-free withdrawals, and no contribution limits. The IRS limits your Roth IRA to $7,000 or $8,000, they say. But this vehicle has no limit. You can dump in $500,000. Here is the catch they don't explain. To get that tax-free access to your money, you are not making withdrawals. You are taking loans. You are borrowing money from the insurance company, using your cash value as collateral. Because it is a loan, it is not income, so it is tax-free. And because you are borrowing your own money, the insurance company charges you interest, but they also credit you interest, often creating a wash loan, where the net cost is zero. Sounds perfect. Until you look at the cost of insurance, COI. Inside every IUL policy is a term life insurance component. You have to pay for the death benefit. As you age, the cost of insuring your life gets exponentially more expensive. In your 40s, it's cheap. In your 70s, it gets pricey. In your 80s, the cost of insurance can become a vertical line on the chart. This creates the implosion risk. Imagine you are 85 years old. You have been taking tax-free loans for 20 years to supplement your retirement. You have borrowed nearly all your cash value. Suddenly, the internal cost of insurance spikes. The policy needs more cash to stay alive. But you have drained the bucket. You receive a notice in the mail. Pay $50,000 in premiums within 30 days, or your policy will lapse. You don't have $50,000. You let the policy lapse. This is the nightmare scenario. When a policy with outstanding loans lapses, the IRS treats every single dollar you ever borrowed as taxable income in that 1 year. You are 85, you are broke, and you just received a 1099 form for $500,000 of income. You owe the IRS $150,000 immediately. This is the tax time bomb that the webinar never mentions. They show you the tax-free income. They don't show you the tax catastrophe exit if the policy isn't managed perfectly. Furthermore, the fees to set up this tax-free shelter are astronomical compared to a Roth IRA. If you put $50,000 into a Roth IRA over several years, every penny works for you. If you put $50,000 into an IUL, a significant chunk of that first-year premium goes to, you guessed it, the agent's commission and the insurance company's expenses. You are paying a massive upfront load to save on taxes decades from now. You have to ask yourself, is the certainty of high fees today worth the possibility of tax savings tomorrow? They will also tell you that this strategy avoids the Social Security tax torpedo. They will explain that if your income is too high, up to 85% of your Social Security benefits become taxable. This is true. But again, does it make sense to buy an expensive insurance product just to save a few $1,000s in taxes on your Social Security checks? Often, the cost of the insurance, the mortality charges and admin fees, exceeds the tax savings you are generating. You are stepping over dollars to pick up dimes. So we have covered the market crash fears, the liquidity traps, and the tax scare. The webinar host is running out of ammunition, but they have one final card to play. It is the emotional trump card. It is the argument that goes beyond money and touches on your legacy, your family, and the inevitable decline of your health. They are going to pivot to long-term care. They will cite the statistic: 70% of people over 65 will need some form of long-term care. They will tell you that a nursing home costs $10,000 a month. They will tell you that Medicare pays for almost none of it. You will burn through your life savings in 2 years, they warn. You will leave nothing to your children. And then, miracle of miracles, they will reveal that the annuity or life insurance policy they are selling has a doubler, a feature that doubles your income if you get sick. It sounds like the answer to your prayers. But in the next part of this masterclass, we are going to read the medical definitions inside that rider. We are going to find out just how sick you actually have to be to trigger that benefit, and why activities of daily living is the most important phrase you have never heard of. We will expose why the doubler is often impossible to qualify for until it is too late. The lights dim on the webinar. The host's voice softens, becoming almost reverent. They display a photo of an elderly couple holding hands on a park bench. Then the image fades to black, replaced by a stark white number: $10,000. This, the host says, is the monthly cost of a semi-private room in a nursing home in 2025. Medicare pays for almost none of it. If you get sick, your nest egg doesn't belong to you anymore. It belongs to the facility. This is the emotional pivot. They have scared you with the stock market, they have terrified you with taxes, and now they are going for the kill shot, the fear of becoming a burden to your children. They know that for many responsible people, the only thing worse than dying broke is living broke and forcing your daughter to change your bedsheets. But then the solution appears: a rider attached to the annuity they are selling. It is often called the income doubler or the health multiplier. The pitch is simple. If you get sick, we will double your monthly paycheck. If you were getting $4,000 a month, we will bump it to $8,000 to pay for your care. And the best part? It costs you nothing up front. Sounds like a miracle. It sounds like long-term care insurance, but without the messy medical exams or the use it or lose it premiums. But let's open the contract and read the definitions that determine if you actually get paid. First, we need to talk about the trigger. To activate this doubler, you usually have to prove you cannot perform 2 out of the 6 activities of daily living, or ADLs. You need to memorize this list because your financial survival might depend on it. The 6 standard ADLs are bathing, dressing, toileting, transferring, moving from bed to chair, continence, and eating. Here is the catch. You have to be physically unable to do them without substantial assistance. Let's say you have severe arthritis and it takes you 20 minutes to button your shirt, but you can still do it eventually. You do not qualify. Let's say you can walk, but you are a fall risk. You do not qualify. And then there is the cognitive loophole. Many older policies were written before the current understanding of dementia and Alzheimer's. If you are physically fit, you can dress yourself, feed yourself, and use the bathroom, but you have severe dementia and cannot be left alone because you might leave the stove on or wander away. You might not qualify for the doubler under the strict ADL definition. You are dangerous to yourself, but you are functional according to the contract. Now let's look at the confinement trap. The webinar host implies that this money can be used for home health care, allowing you to age in place. But many of these riders are strictly confinement riders. This means the benefits only kick in if you are admitted to a qualified nursing facility for a minimum period, usually 90 days. If you hire a visiting nurse to come to your house, no payout. If you move into an independent living community that offers some support, no payout. You have to be in a facility that meets specific licensing requirements. The industry knows that most people desperately want to avoid nursing homes, so they sell a product that only pays if you enter the one place you swore you would never go. But the biggest deception is the funding mechanism. This is the part that borders on financial alchemy. When you buy traditional long-term care insurance, you pay a premium, and if you get sick, the insurance company opens a vault of their money to pay your bills. Your savings remain untouched. The doubler on an annuity works differently. In the vast majority of these contracts, the insurance company is not giving you new money. They are simply allowing you to access your own money twice as fast. Recall the income base, that fictitious ledger number we discussed in Part 6. When the doubler kicks in, they double the withdrawal rate from that base. But where does the actual cash come from? It comes from your account value, your real principal. You are draining your own bucket at double the speed. Imagine you have $500,000 in the account. The doubler turns on. You are pulling out $50,000 a year instead of $25,000. After 10 years, your account value hits zero. What happens then? This is the gotcha clause. In many contracts, once your account value hits zero, the doubler stops. You revert to the standard payment, or in some cases, the payment stops entirely. Just when you are oldest, sickest, and have lived long enough to drain your account, the safety net vanishes. You were essentially robbing your future self to pay for your present care. Compare this to a long-term care partnership policy or a standalone plan. In those plans, if you exhaust your benefits, the insurance company continues to pay, or the state Medicaid program picks up the tab without forcing you to liquidate all your assets. The annuity rider offers no such protection. It is a spin-down vehicle, not a true insurance pool. Let's look at a case study. Meet Bill. Bill is 75. He bought an indexed annuity with a nursing home doubler 10 years ago. He suffers a stroke. He is rushed to the hospital and then discharged to a rehabilitation center. He thinks, "Great, my policy will pay." He calls the insurance company. First, they tell him about the elimination period. He has to be confined for 90 consecutive days before he sees a dime. Medicare stops paying for rehab after day 20, usually, or day 100, partially. Bill has to pay out of pocket for the gap. Finally, day 91 arrives. Bill qualifies. The check doubles. He is relieved. But 2 years later, Bill recovers enough to go home. He still needs help, but he isn't in a facility. The insurance company stops the doubler. Now Bill has to pay for home care out of his standard monthly check, which is still the same amount it was 10 years ago because inflation isn't covered. Bill realizes too late that he didn't buy long-term care insurance. He bought a nursing home accelerator. He bought a product that protects the nursing home's revenue stream, not his lifestyle. And the cost for this rider? It was likely 1.15% per year, charged against his account value for 10 years. On a $500,000 account, Bill paid over $50,000 in fees for a benefit that simply gave him permission to spend his own money faster for 24 months. The webinar hosts won't show you Bill's story. They will show you a chart where the income line stays high forever. They will use phrases like peace of mind and dignity. But dignity isn't found in a rider that drains your legacy. It is found in having a liquid, flexible pool of assets that you control, not an insurance carrier. We have now dismantled the entire webinar funnel. We have exposed the fear marketing, the fake scarcity of the invite, the fuzzy math of the charts, the commission grid behind the advice, the tax scare fallacies, and the healthcare illusion. You are now armed with the truth. But this leaves us with a massive burning question. If these webinars are traps and the free steak dinner seminars are sales pitches, where are you supposed to go? Who can you actually trust? There are good advisors out there. There are professionals who act as fiduciaries, who charge transparent fees, and who build plans based on math, not commissions. But they don't usually have big marketing budgets. They don't scream at you on Facebook. You have to know how to find them. In the final part of this masterclass, we are going to give you the litmus test. We will give you a specific list of 5 questions to ask any financial advisor before you hire them. These questions are designed to cut through the sales script and reveal their true incentives. If they stumble on these questions, you run. If they answer them clearly, you might have found a partner for life. We will also give you a safe exit strategy. If you have already bought one of these annuities and are feeling sick to your stomach, do not panic. We will discuss your options for getting out, what the penalties might be, and when it actually makes sense to keep the policy. This is the conclusion, the final verdict. Part 10 is coming up next. We have arrived at the moment of truth. You have sat through the fear-mongering, dissected the misleading charts, and exposed the invisible machinery of commissions that powers the retirement webinar industry. You now possess something that 99% of the attendees in those virtual rooms do not: leverage. You know how the game is played. Now we are going to teach you how to win it. Whether you are currently interviewing an advisor you met through a Facebook ad, or you are staring at a policy you already bought, you need a tactical plan. We are going to start with the litmus test. These are 5 specific, non-negotiable questions you must ask any financial professional before you sign a single document. Do not ask these questions politely. Ask them clinically. Write down the answers. If the advisor hesitates, deflects, or gets defensive, the interview is over. Question number 1. Are you acting as a fiduciary 100% of the time regarding my assets? Listen carefully to the answer. Many advisors are dually registered. This means they can wear a fiduciary hat when charging you for a financial plan, but switch to a salesperson hat when selling you an insurance product. You want a fee-only fiduciary who is legally bound to put your interests first in every single interaction. If they say they are fee-based, be careful. That one-word difference often means they can still accept commissions. Question number 2. Please provide me with a written statement detailing the exact dollar amount you will receive in commissions, trails, and overrides if I purchase this product. Do not accept percentages. 6% sounds small. $30,000 sounds like a car. If they say they don't know the exact amount, they are lying. The insurance company provides them with a commission schedule. Demand to see it. If the product is truly good for you, they should not be ashamed of what they are paid to sell it. Question number 3. What is the surrender value of this account on day 31? This cuts through the illusion of the bonus. If you deposit $500,000 and the bonus brings it to $550,000, but the surrender value on day 31 is $460,000, you are immediately underwater. You need to know the cost of freedom. Question number 4. Can you show me a side-by-side comparison of this product versus a portfolio of low-cost index funds and treasury bonds over the last 20 years, including dividends? Most webinar hosts will refuse to do this. They will say you can't compare them because they have different risk profiles. That is a dodge. You are comparing two places to put your money. One has low fees and high liquidity. The other has high fees and low liquidity. You need to see the opportunity cost of safety. Question number 5. If the stock market stays flat for the next 10 years, what is my total return after all fees? In many annuity contracts, if the index is flat, you earn zero interest. But the fees, rider fees, admin fees, continue to drain the account. In a flat market, safe products can actually lose value. You need to see the zero growth illustration, not just the bull market illustration. Now let's address the elephant in the room. What if you are watching this and your stomach is in knots because you already signed the contract? What if you bought the annuity 2 years ago? Is it too late? First, check your calendar. If you signed the policy recently, you are likely within the free look period. This is a state-mandated consumer protection right, typically lasting 10 to 30 days after you physically receive the policy. You can return the contract for a full refund. Do not call the agent to do this. They will try to talk you out of it. Send a certified letter to the insurance company's home office immediately. This is your get-out-of-jail-free card. Use it. If you are outside the free look period, you have to do the break-even math. Let's say you are 3 years into a 10-year contract. Your surrender penalty is 7%. The internal fees of the product are roughly 2.5% per year, and the returns are capped at 4%. If you move that money to a low-cost portfolio earning a historical average of 7 or 8%, you might recoup that 7% penalty in just 2 or 3 years. Sometimes, paying the penalty is the smartest financial move you can make. It is the amputation that saves the patient. Do not fall for the sunk cost fallacy. The idea that because you have already paid fees or time, you must stay. Calculate the future drag. If the product is going to underperform the market by 3% a year for the next 15 years, that is a cumulative loss of over 50% of your potential wealth. A 7% penalty is a bargain compared to that. However, there is one scenario where you should absolutely keep the policy. If your health has significantly declined since you bought it, and the policy has a death benefit that exceeds the cash value, it may be worth keeping as a legacy tool. Or if you have become uninsurable and the policy has a genuine long-term care rider that you are likely to trigger soon, do not cancel it. In these specific health arbitrage cases, the insurance company is the one losing money. So where do you find the good guys? If the webinar hosts are conflicted, who isn't? You need to look for advisors who sell advice, not products. Look for credentials like CFP, Certified Financial Planner, or CFA, Chartered Financial Analyst. Look for membership in organizations like NAPFA, the National Association of Personal Financial Advisors, or the Garrett Planning Network. These organizations require their members to be fee-only fiduciaries. Go to the SEC's Investment Advisor Public Disclosure website, IAPD. Type in the name of the person who hosted the webinar. Look at their Form ADV Part 2. This is the Truth Serum document. It lists every conflict of interest, every disciplinary action, and exactly how they get paid. If you see a section that says, the firm receives compensation from the sale of insurance products, you know that their advice is compromised. This brings us to the final verdict. Are retirement planning webinars worth your time? If you view them as entertainment, perhaps. If you view them as a window into the anxieties of the American middle class, certainly. But as a source of unbiased, actionable financial planning? The answer is an emphatic no. The webinar model is not designed to educate you. It is designed to filter you. It is a sorting mechanism meant to find the people who are frightened enough to abdicate control of their life savings. The script, the scarcity, the fear, it is all engineered to bypass your intellect and target your lizard brain. True wealth management is rarely exciting. It doesn't happen in a limited time only virtual room. It happens in boring conversations about asset allocation, tax bracket management, and estate planning. It involves reading the fine print. It involves accepting that markets move up and down, and that risk is the price you pay for returns. There is no magic product that gives you stock market gains with zero risk. There is no secret IRS loophole that eliminates all taxes without a catch. There is only math, discipline, and time. You are the CEO of your own retirement. You spent 40 years earning that money. Do not hand the keys over to someone just because they bought you a steak dinner or scared you with a PowerPoint slide. You have the tools now. You have the knowledge. You can read the contract. You can ask the hard questions. The power is back in your hands. We have spent 10 videos dismantling the traps. Now it is time to build the fortress. In our next deep dive series, we are going to leave the world of bad products behind and focus on the mechanics of building a fortress balance sheet. We will break down the 3-fund portfolio, the art of Roth conversion ladders, and the exact withdrawal strategies used by the ultra-wealthy to preserve capital for generations. We are going to show you how to do it yourself or how to hire a professional who works for you, not the insurance carrier. If you thought this series opened your eyes, you haven't seen anything yet. The Retirement Fortress series begins next week. Make sure you are subscribed. Make sure your notifications are on. Class is dismissed.